Hello everyone, this is Monday, June 24th, and U.S. markets are closed for the evening. I wanted to make a update today on the U.S. stock market, give an opinion on where it's at and what to look for here. First off, we're looking at a chart here of the S&P 500 ETF SPY. This is a daily chart, and the point of note on this chart is that these light blue lines here are some Bollinger Bands, and let's actually go in there and make those a little bit darker so you can see those better. So these are Bollinger Bands, which are indications of standard deviation or volatility in the market, and I've pointed this out repeatedly over the last few years on some different patterns. But whenever we see the market enter a period where the bands are channeling or squeezing, as we see here where the bands are running roughly parallel, and then we see the market break out and close above or below one of the Bollinger Bands while the bands are expanding, meaning they're the top one is up and the bottom one is pointed down with a close outside of the band. That is a volatile formation and can lead to some very significant price moves in a short period of time. And the longer price is able to hug and close outside of that, outside of one of those bands, the more likelihood in the case when you're looking at a downside move like this to see an extreme volatile move. So what this basically means is that volatility is exponentially or increasing, or it's accelerating. The market is not able to muster up enough strength in order to close back inside these bands. And as long as it stays outside this lower band, we are in a expanding volatility environment. So it would not be impossible to see the next day down 3 or 4%, or even see one of these major wipeout days like we saw in 2011 and like we've seen here or there over the past several years, where the market ends up dropping 5, 6, 7, 8, 9% in a day, and those can create some very profitable opportunities on different trading strategies. But what I'm pointing out here is that we're currently 3 days in a row closing below this lower Bollinger Band on the S&P 500, and the bands are still expanding away from each other. Today we saw price gap down, make a lower low, rally up, and try and get back inside those bands. And then right around the time it touched the bands, selling came in and it closed the day near the mid-range. So it was essentially an attempted reversal today, but one that did not pan out into a typical looking reversal type of move. So this is something I think you need to be mindful of here, that if we continue to see in a lower low below below today's low, things could get ugly relatively fast in the markets here based on that Bollinger Band configuration. Hang on here, I think we have something crashing. Let's load that back up. So point being, this is just a warning to understand that in this technical environment where we have volatility expanding, price hugging those lower bands, that you need to be careful with bottom picking if you're looking to be a buyer in a market like that. I always prefer, when we see a market like this, to if you are going to try and buy bottom pick here, you want to at least go to a shorter term time frame. So if you're looking at a daily chart, I would recommend the hourly time frame as a shorter term time frame. So let's go and look at that, and let's move this here and shrink this MACD. And so what we're looking at here is SPY, but on an hourly time frame. And we can see that the MACD indicator is very, very oversold. So it's the most oversold it's been in a few months here. However, there's no divergence on the MACD indicator. So when you're seeing this volatile type of formation, we saw this gap down, we've seen price continue lower. At a bare minimum, before going long, with any safety, I like to see a divergence pattern develop. So see the market consolidate or rally for a couple of days, and then push to a lower low, where the indicator actually makes a higher low, and then if we can then see the indicator cross up and we see price start to move in the upwards direction, then we could potentially look to be a buyer with a stop below whatever low forms there. However, you would definitely want to have the stop in place there, because if price would continue to make lower lows, that would indicate that it's still open to the possibility of a dramatic swoon to the downside. So those are days that can be very, very painful if you're on the wrong side of them. So understand there's an opportunity coming up here, probably. However, you need to be patient and wise in what your strategy is to try and capitalize on those opportunities. So let's move out and look here again at a daily chart. These three lines on this chart here, these three black lines, these are the corrections that we've seen in the market since the October 2011 bottom. So in the last year and a half or two, we saw a couple, three substantial corrections in here. November 2011, April and May 2012, and then October, November of 2012. And right now the market is declining roughly in line with those. If we see price come down and make a larger decline in these, significantly larger, maybe down into this 145 or even low 140 region, that would be something where we would need to consider the very real possibility that there is a completed bull market in place at the current time frame. Now, we're not quite there yet, and I think there's a possibility that we see some continued sideways type of trade or even seasonal weakness into the fall time frame before the next rally is attempted. Whether that would push to new highs, I don't know, but right now the indications are obviously the market is in a correction. As I've pointed out here, near the highs in May, basically right at the highs, to be mindful of that. We've certainly seen the market come down a good bit here. Just for historical reference, a typical correction in the stock market historically is around 1.5 to 2 months, and roughly a 10 to 11% decline. And I pointed that out in prior videos that that may take us down from this 170 level or 169 level on SPY, roughly down to the lower 150s here for a normal correction. And we're around the mid 150s right now, so we may have a few more percent to the downside, even just to fall in line with a median or average type of correction on a historical basis. Looking at the MACD indicator down here, we haven't even seen the signal line here, the dark blue line, even cross below zero. So on larger developed corrections, we often see that MACD actually gets significantly oversold, and it looks like we're probably a couple weeks off from that being significantly oversold on that signal line. So I don't know that this correction is really close to being done here. However, there are a few initial extreme readings starting to show up in some of the gauges of sentiment and breadth in the market, but it's something here where I think we probably do have some more time to be consumed, even if we are looking at just a correction in a continuing bull market in these markets. On a weekly time frame, I pointed out, I believe in the last video, that if we saw any substantial further downside below not last week's low, but the week before that, the parabolic SAR would likely trigger. We did see that here last week, so we're now on a parabolic sell signal coming off of a overbought weekly time frame signal. So as long as the market maintains below the weekly and the daily time frame signals there, I think we need to give the downside the benefit of the doubt and look to, if you're rather a nimble trader, then you need to be looking at some shorter term time frames, wait for the market to rebound, give some type of a rally, and then look to short that. As far as support below current prices, we don't have any major support until we get back at this high of 2012 up here in September. It'll be around 148 on SPY. And then obviously there's some significant consolidation in at this high 130s levels between the highs here in 2011 and 12, and then this low in this correction here. So as far as where the probable end to this correction would be, I would say probably somewhere in that range. I would think we could fall probably into the 150 or even high 140s, and that may be even if we are looking at a continuing bull market rather than a bear market. We may see a deeper correction coming off of this pretty dramatic move up here in the last several months. So that's something to be looking for anyway, and especially given in the state of some of the commodity markets where gold and silver have just gotten hammered. I may touch on those briefly here before the end of this video, but if I think there is some indication that there are some aspects of the market that are extremely oversold, and if we do see those turn the tide, we could see another substantial move up, inflationary type of move in the markets prior to a final bull market high. But that's it's getting a little ahead of things there, but that's just some thoughts on the longer term. This is a chart of the NASDAQ. This has a RSI. This is a daily chart. RSI is not oversold yet on some relatively complex type of corrections. A lot of times we will see that RSI get oversold before the correction is over, so that's something to look for over the next week or so here, is look for it to get oversold and then possibly for a divergence pattern to develop like this, where we see a higher bottom in the RSI with a lower bottom in price. Those can be very nice signals in the RSI. So that's again another technical signal to look for. As far as the sentiment of the current market, let's look at the put-call ratio here. This is the total put-to-call ratio, and this is a chart I've shown frequently in the past. But right now we're seeing somewhat of a divergence pattern in that on the decline into June 10th in prices, we saw this move up here in the put-to-call ratio, and then even though we're at lower lows in prices now, and you would typically anticipate seeing more fear in the market, we're actually seeing a lower peak in the put-to-call ratio. If we do see the ratio start to drop here and come below the 1.0 level that it made on June 19th, then that would be some indication that we may have seen a corrective bottom in place in stocks. But if we do see continued decline in stocks and we see this ratio continue to push higher, which in my opinion would be likely with a very significant swoon in the markets, if we do continue lower here, I think we could see a substantially volatile type of move lasting at least a few days in the market. So something to be wary of there again by analysis of the put-to-call ratio, that we're possibly a bit extended, but compared to some of the extremes in the past, we're not even really close to the extreme levels we saw in 2012 or 2011. So we could see a significant amount of fear enter the marketplace here as far as put trading goes, prior to seeing the type of readings that have been so reliable over the past number of years. This is a chart of the McClellan oscillator, which is a measure of breadth, and we've seen that an interesting type of formation here. A lot of times in the direction of trending market moves, you'll see multiple pushes in the same direction near extreme levels in stocks, like we saw here in an uptrend, like we saw up here in an uptrend. Whereas we've seen over the past several months, since the middle of November 2012, we've seen the market in a strong uptrend, and we've seen these declines in the McClellan oscillator form relatively sharp peaks, followed by pushes to higher highs. Now we've seen some lower readings in the oscillator, and we've seen some repeated hovering in negative territory here, which may be an indication again that a correction is underway, and that the trend is to the downside in stocks here. So until proven otherwise, there's some indications that there are a number of stocks turning lower, and the market breadth is trending to the downside. Moving over to the VIX briefly, the VIX is touching up near the 20 level here, which has been somewhat of a resistance level over the past year or so. However, as we've seen, several times in the past couple years. We've seen some dramatic spikes in the VIX, even up into these 40s. In 2010, in May of 2010, June of 2010, and then into August of 2011, we saw another dramatic move there. So in those instances, we saw relatively large corrections occur in the market, and a significant amount of the price damage came in just a few days. So that's what I just want to, give a warning of here, is that it's possible to see that type of move, especially given the Bollinger Band configuration in the market, where we have the exact setup that you typically see when those volatile moves occur. That doesn't mean it has to occur. If it doesn't occur, in fact, we're probably looking at forming a bottom relatively soon. But if it does occur, then we could see some major downside in just a couple of days in the market here. Now moving on to the gold market, I want to touch on briefly here, in the silver market. If you go back through my blog and you search silver or gold, you can look back through the last couple years of posts relating to that, and there have been a number of times where I've really just hit the nail on the head with projections in those markets. So I feel that I have to some extent a leg to stand on, given some of the projections and calls I've made in these markets over the last few years. And these two lines right here. Let's move out to a weekly chart. These two black lines right here were projections that I had placed on my chart back when this support level was broken in April. When these support levels were broken, that those would be some targets based off of the size of this move from the top to the support level, and then also this move here from the lowest point of this of these kind of three peaks here to the support line, that those would be some rough targets or estimates that we may see the market decline to. Now, given this large-scale bull market here from 2008 into 2011, it's very extensive and made a significant gain, and about tripled in price, almost there. And these bull markets can be retraced rather extensively, and this green line here represents an 86% retracement of the entire bull market in gold since 2008. And given this, some of the price and time duration of this bull market here, it would not be unexpected compared to historical commodity bear markets for this to be a major bear market and take us back down to a deep retracement of this bull market before bottoming. Now, with that being said, I had mentioned a couple months back an analysis of the commitment of traders data, which is basically looking at the speculators and the smart money hedgers in these markets, that if we saw the commitment of traders data, if we saw the smart money getting near net long or actually even go net long when they're actually hedgers and historically almost always maintain a net short position, if we see them get to net long, that would be just a screaming indication to be on alert for a bottoming type of a pattern, and to be a buyer, or at least look to be a buyer of the market on appropriate technical signals. And we're actually nearing that currently, in that both silver and gold have some very, very, very significant buying coming into the market compared to historical levels when you look at the smart money. So they are not at a net long position yet, but they're getting close to it, and the smart money is the most bullish it has been in years on these markets. So we don't have any type of bottoming pattern in place or significant price reversal pattern in place yet in gold or silver, but this is something that I think if we do see any continuing downside, we need to start looking at this as a market that is probably much closer to a bottom than to a top, and be on alert for weekly time frame buy signals to come into play there. So that's the gold market. This is the silver market. In this level here, I think I put even back in 2011 that if we do see a bear market occur in silver, that we could see it come back down into this 15 level or so here. We're currently at around 19, and it seems like a lot to bring it down to 15, but when the markets are exceptionally volatile like this, it would just take some type of final volatile move to spike down in these markets and push it substantially lower. What I would really be looking for here personally before the gold and silver market's bottom would be, or at least put in a bear market bottom, would be to see a stronger divergence pattern. So you're looking at a MACD chart under here on a weekly chart of silver, or at least the SLV ETF, which tracks silver, and there is no divergence, so it's at new lows for the move. So I think what would be probable and maybe ideal for a bottoming pattern would be to see a multi-week or even multi-month rally in silver, followed by another move to lower lows in silver that may take us down into this congestion zone from 2009, 2010, or even lower, even back closer towards this 2008 bear market low. Possibly even cutting that low. I don't know, but I think that would be the higher probability bottoming scenario, in my opinion, would be to see maybe a rally here and then a decline possibly into the fall or fall or winter, something to that effect, prior to bottoming in these markets. So those are some heads up to keep on gold and silver, because if a buying opportunity does come in play, and you're seeing these markets, silver is down around 60% from its bull market high. That's a very significant bear market. The bear market's lasted about 2 years, so that's a very mature bear market, and it's certainly the possibility that if we do see a bull market occur again in silver, if we do see a bear market bottom here and a new bull market start, that we could see that bull market push above these 2011 highs. Let's say we bottom somewhere here around 15. Well, that would be a 200% gain just to get back up to these old highs, and if it would happen to break them and have any substantial move, you could be looking at some major gains in some of these commodity asset classes. So again, that's a little bit longer term to look for, but something to keep on the radar. One commodity that I do like the looks of and would look to potentially be a buyer of on appropriate technical signals is the cotton market. So we saw cotton make its low here in June of 2012, and despite commodities as a whole trading mostly lower over the last year or so, we're seeing a series of higher bottoms in cotton, and that's after a major bearish move. So from 2011 we saw cotton move from roughly 120 all the way down to 40, so we saw 60 to 70% decline in cotton. So a significant bear market, and we're seeing some corrections here. So if we were able to see cotton push up above this recent high here from June, or this high here from March, we may be headed for some significantly higher highs in cotton. So that's this chart we're looking at here is BAL, which is an ETN that tracks cotton prices. So that's something that for technical traders, if you have an interest in commodity tracking funds, to keep on your radar there as well. So I hope that this information was helpful and gives you some things to look for. Don't know what to look for here, but today's attempted rally and failure doesn't look real encouraging for the short term. I think we could be in store for some more increased volatility and some lower lows, at least for a few days, prior to any meaningful multi-day or multi-week rally in stocks. Some of these other markets I think we just have to treat independently at the current time frame. This last chart I'm going to show here is a bond ETF TLT, and it's something that I've pointed out several times over the last few years, is that to be looking for a major topping pattern in bonds, and I had made a video that showed that there was this harmonic type of pattern here where we had this move into a high, and we had this ABC type of pattern here, and the market reversed off of that, and we saw it enter this uptrend, and I suggested that if we saw that pattern fail and we saw prices move back below that low, that a failure of that pattern may be a longer-term indication of weakness to come in the bond market. We did in fact see that here. And at the end of May and currently. And if you look at the chart pattern here, you're looking at a relatively standard looking head and shoulders type of pattern here. So we have a shoulder, a head, a shoulder. We have an upsloping neckline. We had the break of the neckline, a little bit of a volatile move back up towards the neckline right here, and then the market's just gotten hammered the last few weeks. So the standard projection based off of a head and shoulders pattern would take the head to the neckline, project it down from the break of the neckline. So we could see this market move down another 10% or so just to meet the minimum chart projection based off of the head and shoulders pattern. And given some of the very long-term trends in interest rates, this could be a major even a multi-decade high in bond prices here. We could be looking at a major low in interest rates, so a major low in interest rates for the long term here. So again, that's something, if you go back and you search bonds or interest rates on my blog, you can go back through past posts and get some more some details on that and look for some of the longer term charts I've showed in the past. But essentially here, I think we need to be aware that the trend in bonds may have turned down. All right. Another interesting point of note, and I don't know the significance of it yet, though I've talked about it a couple times over the past few years, that based off of studies of some past markets, what we've seen over the last couple of years is a very consistent and relatively strong inverse correlation between stocks and bonds. So when bonds are moving down, stocks are typically moving up. However, over the last couple of weeks and after this most recent Fed announcement, we've seen bonds and stocks move in tandem. So we've seen them both move down. And I've talked about in the past that if we get to a point where we're seeing stocks and bonds move down, that might be indicative that the bull run in stocks is done. I don't know that to be the case for sure, but in any case, even with stocks declining, bonds have not been able to rally. I think that is an indication of weakness in bonds. What I think is less clear at this point is whether that is an indication of weakness in stocks for the longer term. So my take on this is that based off of this pattern, the larger term trend in bonds has turned down, and if you're a shorter term trader, you could look for multi-day rallies back towards the moving averages or a moving average channel to look to be to short bonds in anticipation of a move back down to at least meet this minimum projection around 98 on TLT for the head and shoulders pattern. If there are any questions on this analysis or anything specific any readers or watchers would like, please just drop me a comment and I will try to accommodate you as far as showing some charts on the blog or in some videos here. So that is all for this evening. All the best to your trading.